you, everyone, for taking time out of your busy days to listen to this entry in the Money Matters series. 6 months ago, there is no way any of us could have known how appropriate this topic would be. In January, the headlines were full of news about a tragic helicopter accident with Kobe Bryant and impeachment and China trade strife. Fast forward to now, and we saw the fastest 30% drop in the S&P's history and then a rocket 40% recovery out. Where we stand today gives us a great opportunity to look back at the last few months and either reaffirm our risk tolerances or perhaps make changes based on our individual experiences, how we felt about this time. This is why the subtitle is Finding a Path That Works for You. We all have to find what works for us. My name is Isaac White, and I am a senior portfolio strategist in our personal trust group, and I am co-presenting with Justin Marcinkiewicz, who is an institutional portfolio strategist in our institutional group. Let's pause a moment for disclosures. So today, we're going to first define the types of risks that we'll be addressing. Hint, hint, market risk and human risk. We'll then talk about things that you should consider in your own lives when determining your risk tolerance, and finally, how to begin implementing your plan. We're going to define market risk as the ups and downs of our money. This means both the value you see on your computer screens and statements when you check your balances and the purchasing power of that money. Human risk is the ups and downs we feel, which may lead us to make investment decisions. I'll start by saying market risk is systemic and cannot be wholly avoided. What we choose is the type of market risk we'd like to take on. And you can see here a list of types of risk. The two that we'll discuss are equity risk and inflation risk. Equity risk is the ups and downs in the stock market. Here you'll see the S&P 500 over the last 100 years with the gray bars indicating bear markets. You can see that while it generally trends up, there are many ups and downs or volatility. How exposed you are to equities determines your equity risk, i.e. volatility. So, how aggressive are you? Think of it through terms of your asset allocation. If you have 90% in stocks and 10% in bonds, you have an aggressive asset allocation. If you are taking on equity risk. If you only have 30% in stocks and 30% in cash, then you have less equity risk but more inflation risk. There is always a trade-off. Asset allocation matters because over 90% of your long-term returns will be determined by your asset allocation. It matters because you may be over or underexposed to equity risk depending on things like your age, time horizon, and emotional ability to handle volatility. Inflation risk is real too. We all know the power of the dollar declines over the years. From 1980 to 2016, a dollar shrank to about 29 cents of purchasing power. Two groups may fall in the inflation trap. Believe it or not, millennials are one. They save, but they don't invest, partly attributed to watching parents live through the great financial crisis. They are doing great long-term harm by not investing and letting inflation steal from them. The other group are retirees. We're living longer and longer. A 65-year-old couple today has a 50-50 chance of one of them living to age 93. That's almost 30 years. Those who become too conservative too quickly in retirement put themselves at risk in their later years. I'll now turn it over to Justin to discuss human risk.
Great. Thanks, Isaac. Now, when we think through the term risk tolerance and what its application is to investors, Isaac and I believe its core principle is the ability for investors to watch the market or their investable assets sell off during times of market uncertainty, which is the risk component, and not take action on those investments, which is the tolerance component. So said another way, can an investor tolerate a 20% sell-off, a 30% sell-off, before feeling the need or requirement to take action and mitigate the downward market activity? Investing your hard-earned dollars into the market and watching the balance go up and down over time can be emotional. We are acknowledging that certainty. However, as investors, we must avoid the possibility of emotions driving investment decisions. During times of heightened market uncertainty, that is likely the precise time when we as investors need to stick to the investment strategies that were put in place and not change course. This concept of emotions causing us to change our investment approach during uncertain times is what Isaac and I call human risk, and hope to provide a framework for managing this risk. Now, the first thing that should be done when determining your risk tolerance is have an honest conversation with yourself, your significant other, your financial advisor regarding life and personal finance objectives. You need to define what's important to you and what you're hoping to accomplish with these investable assets. Next, you need to develop a financial plan that is tailored towards your goals. You would be determining the priority, the timing of such goals, how much capital would be needed to facilitate each goal. Once those building blocks are put in place, the next step will be selecting an investment strategy that is congruent with your plan. And then last but not least, the final component of this human risk framework is to stick to the plan. As long as life and personal finance variables have not changed drastically, have confidence that your plan and investment strategies are still very appropriate. Now on slide 16, when people deviate from the investment plan based on various market, economic, or political environments, I tend to believe that those actions are a form of market timing. A deviation could look like selling your investments and moving all to cash, or it could look like de-risking your allocation by holding less equities and more fixed income than what your plan calls for. And now on slide 16, this is a depiction of how time in the markets and not timing the market can lead to investment success. The first bar labeled fully invested on the far left, that scenario illustrates if you made a $10,000 investment into the S&P 500 at the beginning of 1999, and you didn't look at your account until the end of 2018, so a 20-year horizon, and that initial $10,000 investment would have turned into almost $30,000. Now, the second bar from the left illustrates if you made that same initial investment, watched your account day after day, and moved to cash periodically, ultimately missing the 10 best days over this 20-year time frame, you can see that that $10,000 investment only grew to roughly $15,000, half as much as if you stayed fully invested. And this impactful trend continues as investors miss more of those best days over the 20-year window. So what's important to take away from this illustration is, one, nearly half of those S&P 500 best return days occurred during a bear market, and then two, missing those best return days are very impactful to the investor's overall return experience. During times of heightened market uncertainty and possible strain on investor emotions, this is precisely when it's most important to stick to the plan and your appropriate investment strategy. Now I'll pass the presentation back to Isaac to speak to things to consider in your risk tolerance.
So what should we consider when determining our risk tolerance and asset allocation? Timeline matters a lot. The longer the time frame between now and when you need the money, and depending on your goals, investors may have the ability to be more aggressive. A very conservative rule of thumb is if you need the money within 5 years, seriously reconsider before investing in equities. You also should think about how you've handled volatility in the past. Do you make decisions, good or bad, based on volatility? If you do, reconsider the amount of equity risk you take. How do you feel about your household financial situation? Uneasy about something? may need these savings for something, medical, new car, new roof. You may want to be very cautious with the equity risk you take on. A useful exercise is to think about the 3 A's, about, account, and allocation. Think of a goal and then decide how much you need to save for that goal, the best type of account to save in, and the investment return necessary between now and the goal. If you do this, you'll have buckets for various goals, and each bucket will have its own investment allocation. You can have confidence that, regardless of volatility, you have a bucket of money appropriately allocated based on your time frame and goal. As to how to implement this, back to Justin.
So the final portion of finding a path forward is ultimately implementation. We've notated 3 principles that are applicable to investors no matter what your goals or your time horizon may be. First, you need to select an allocation that's appropriate to you and what you're trying to achieve. History has shown that allocations with more equity exposure tend to have higher returns, but they also hold more risk. Therefore, you want to pick an allocation that is appropriate for what you're trying to achieve. Excess risk-taking could put undue pressure on your financial plan and bring in that human risk potential that we discussed earlier. Second, you should have a diversified investment strategy. Slide 23 illustrates the variability of asset class returns. Each asset class has been color-coded and sorted from highest return to lowest each calendar year. And what you'll find is that there's no one asset class that outperforms all the others year after year. As a result of having a diversified allocation, you may be able to enhance returns over intermediate and longer term periods, but maybe most importantly, you can manage realized risk along the way. And then finally, you should periodically rebalance your portfolio to the intended allocation targets. Over time, a 60% equity, 40% fixed income portfolio can migrate its allocation to 70% equity, 30% fixed income. If your financial plan and commensurate investment strategy calls for 60% equities, you should rebalance. Don't let inherent market drift cause you to deviate from your intended investment strategy. Now, in closing, throughout our Determining Your Risk Tolerance presentation, we discussed various risks that investors face in the marketplace, the importance of sticking to the plan or the impact of not sticking to the plan, things that need to be considered, such as the 3 A's, and some principles to implement in your investments. One thing that you may have noticed is that Isaac and I did not provide a calculated formula to determining or managing risk tolerance. The reason is there's no one circumstance that's applicable to all investors. Therefore, we look to equip you with an awareness of market dynamics and a quick and easy toolkit of best practices. We hope you find this information beneficial in your journey.